Hey guys, this is Ms. Morgan. We're going to work an absorption costing income statement and a variable costing income statement side by side using the same problem so you can see the differences between the two. If you look at the problem here, it says assume that 15,000 units are manufactured and in the same month as they are sold at a price of $50 each. So if they're sold for $50 each, to determine sales, you'll say 15,000 times 50, which is $750,000 for sales. So I'm going to go ahead and fill that in for each financial statement there. Sales is $750,000. Now we're going to work on the absorption costing income statement. It tells us by looking at the problem that the total manufacturing cost for these 15,000 units is $525,000. Well, with the absorption costing income statement, that's going to look just like the income statement you already know how to make, which is sales minus cost of goods sold, and that's $525,000. They've already totaled that up for us in the problem, which gives us a gross profit of $225,000. Remember, we subtract out sales minus cost of goods sold is gross profit. Then you'll take away any period cost, which are your selling and administrative expenses, $125,000. You'll subtract that out to get income from operations of $100,000. Now, with variable costing, it's going to look a little different because you're going to say sales and then you're going to subtract out all the variable cost. Then at the bottom of the income statement, you'll subtract out all the fixed cost. And it doesn't matter if it's a manufacturing cost or a period cost like a normal expense, okay? So your first thing you'll do is you'll say sales minus your variable manufacturing overhead or manufacturing cost per unit, okay? And so here, the cost per unit is $25. That's given to us. We sold 15,000 units at a variable cost, total variable cost of $375,000. So the cost to create those units was $375,000. Therefore, if you subtract that out, the answer is also $375,000, and that's called the manufacturing margin. Then you'll take out your variable cost dealing with your selling and administrative expenses because they tell us there's a cost of $5 per unit sold. So we'll take out that $75,000 variable cost to come up with our contribution margin. So the contribution margin, after you take out all the variable cost, is $300,000. Now we're going to take out our fixed cost. Fixed manufacturing cost are given to us at $150,000. Fixed selling and administrative cost are given to us at $50,000. So we'll subtract out both of these to get income from operations of $100,000. So you see that the variable costing income statement is takes a little bit longer. It's a little more detailed, but the main thing you need to know about that is it breaks up all your variable cost, and then after your contribution margin is determined, then you take out all the fixed cost. So I hope this helps you understand the difference between absorption costing and variable costing.